I'm Dave Wilhelm. I am a professor at Wake Tech Community College in Raleigh, North Carolina. I teach in the Business Administration Department. I teach business, management, and entrepreneurship classes. I teach them in both seated and online formats. I like the seated format because of the interaction. I like the online classes because it makes everybody's scheduling a lot easier. This video is part of an effort so that my online students can get the same explanations for some of the topics that have proven to be a little bit challenging for them in the past. Single and double taxation. So we'll talk a bit about ownership forms, which is why the whole topic comes up. The concept, looking at just a business explanation and an example and an exercise, then combine a little bit of difference analysis, why does it work that way. Then some combined business and personal taxation, both an example and an exercise, a brief look at the difference between paying yourself a salary and collecting dividends as an owner. So ownership forms: sole proprietorship, a partnership, an S corporation, a limited liability company, or a C corporation. And of these, the first four are generally applied flow-through tax. That is, if you're in sole proprietorship, a partnership, or an S corporation, the earnings from that business flow directly to you where you are taxed on those earnings. A limited liability company has a choice. If I were them, I would take the flow-through route, but apparently they don't have to. The C corporation is why we're having this conversation at all. They're the ownership form that is subject to what is termed double taxation. Once at the corporate level, and then once after the owners receive the dividends. So here's the concept. In the left-hand side, if you have a sole proprietorship, partnership, S Corp, LLC, we'll just call it this. You have business earnings and you have personal earnings. You have expenses associated with each of those. The net earnings from each side are simply combined together. You're taxed on them, and what you have left is your earnings after taxes. If your earnings come from a C corporation, we still have revenue and expenses on the business and personal side, but now the business, C Corp business earnings are taxed at the corporate level. When the owners, stockholders, receive the dividends, they are then taxed on those earnings again. And that's where the term double taxation comes from. The personal earnings are added to what's left of the business earnings taxed out here. Here's a business-only taxation example. On the left-hand side, we're assuming that all taxes are 20%, both business and personal. We're also assuming that 100% of the corporate earnings after taxes is distributed to the stockholders. If you have a single taxation business, revenue minus expense, you got $100,000, taxed at 20%, you've got $80,000 left. Pretty straightforward. If you are the owner of a C corporation, revenue minus expenses, you still have the earnings before taxes, but now you're taxed at the corporate level. 100,000 minus 20,000, got 80,000 left. But now when the owners receive them as dividends, they're taxed again. So rather than having $80,000 left, there is $64,000. Here is an exercise for you to do. Revenue of $175,000, expenses of $35,000. Go ahead and do the calculations. I do mention here that this is the tax, not the tax rate, simply because one common error is for a student to calculate the earnings before tax, put the tax rate here, multiply the tax rate by the earnings before taxes, and call that the earnings after taxes. What you want to do is determine the earnings before taxes, multiply that by 20%, put it in this slot, and subtract the tax from the earnings before taxes. And that'll give you earnings after taxes. Same for this side. Go ahead, if you wish to take some time and try this exercise, pause the video, then restart it when you're ready to check your answer. Or if not, just sit back, relax, and I'll show you the answer, which is this. In each case, the earnings before taxes is $140,000. On the sole proprietorship, partnership, S-Corp, LLC side, the tax is 20% of $140,000, which is $28,000. Subtract that, and we have $112,000 earnings after taxes. If, however, we're a C corporation, we're taxed once at the corporate level. 140,000 minus 28,000, we've got 112,000, which is the earnings after taxes at the corporate level. We're assuming that all that earnings is distributed to the stockholders / owners. So tax on that at our ownership tax form, 20% of 112,000 is 22,400. Do the math, and it comes out that we have $89,600 left. If you're thinking, so why would anybody do this? Because it is still profitable. It's very easy to invest in a C corporation, for instance, and they are often very profitable. So it's not a bad deal, but this is one drawback. Okay, unless you are a total math geek, just go grab a snack or something for 2 or 3 minutes. If you are not the kind of person who, when you're driving and you see a license plate, adds the digits together and does some arithmetic on them, if you're not that kind of person, take a break. If you are one of us crazy people who do math on license plates when we see them, stick around for a couple of minutes and we'll go through the math of how the taxation works. So single taxation cash that you get to take with you is just the total earnings minus 1 times the tax rate. If it's double taxation, the cash you get to take is the earnings before taxes times 1 minus the corporate tax rate, that whole quantity times 1 minus the personal tax rate. And you can do some more math and spread it out. If the two tax rates are equal, it comes out the cash is the earnings before taxes times 1 minus 2 times the tax rate plus the tax rate squared. Or if you wanted to check with the business-only example, I think actually this is the business-only exercise, sorry. 140,000 times 1 minus 0.4 plus 0.04. This is 2 times the tax rate. This is the tax rate squared. And sure enough, this predicts that we would come up with $89,600. Again, if you're not a total math geek, sorry for taking up the time. If you are, go do some more calculations. Here's a combined example. And most of us may have some earnings from investments in a business as well as some personal earnings. In this case, our business earnings are $100,000 with expenses of $30,000. Our personal earnings are $60,000 with $20,000 of personal related expenses to get that revenue. And that holds for both examples, the sole proprietorship, partnership, LLC, S Corp, as well as the C Corp example. On this side, we just add them together, get our tax rate, and what's left is $88,000. Once again, all the taxes are 20%, and 100% of the corporate earnings after taxes goes into dividends to the owners. The C Corp side, same starting point, $70,000 corporate earnings before taxes, $40,000 personal earnings before taxes, but now we tax the C Corp earnings at the corporation, so we just have $56,000 left. Add them together, tax it again, and we have $76,800 is the cash we get to take home. Here is an exercise for you to do, same deal as before. If you would like to try this problem, pause the video, do the problem, and then start it again to see the solution. If you just want to see the solution, hang on, here we go. Business earnings are still $100,000 for each case. Personal earnings, $60,000 for each case. On this side, we just add them together, tax them, and calculate our earnings after taxes, which is $128,000. For the C Corp side, first we tax at the C Corp level, get $80,000 earnings after taxes, all of which is going to be distributed as dividends. Add our personal earnings, so we got $140,000, $28,000 of tax, and we're left with $112,000 earnings after taxes, cash we get to take home. One brief observation. If you own a business, you may have a choice of drawing money out of that business as a salary or taking, in effect, dividends out of it as the owner. For a sole proprietorship, a partnership, an S Corp, or an LLC, it doesn't matter because it all flows into your personal earnings anyway, and they're taxed once. If your business is a C Corp, you would probably prefer to take money out of this as an expense rather than as a dividend, because the expenses are pulled out before you're taxed. So in effect, if possible and legal and according to the tax code, you can pull it out as an expense to your total earnings, you avoid the double taxation. Whereas if you have to pull it out as dividends or earnings as the owner, you're going to get that double taxation. That's it on single and double taxation. I hope this cleared up any confusion there may have been. Hopefully it did increase it. If you want to send me a comment or a question, just send me an email.